Happy Friday, everyone. It's Friday morning. It is 9 a.m. Eastern, and we've had a really good week. Stocks have traded up. We had a pretty glorious day yesterday for some stocks. There was a lot to pick from that were just up so much. And we have some good long term stocks that are really performing great. And this morning, we're going to go over a number of stocks that we had in mind. Some of them came up yesterday in the live stream. So we're going to kind of touch those a little bit. And we'd love to hear from you on what stocks you think are worth taking a look at. As you guys know, members can put those in the chat. We'll take a look. If you're not a member, a $5 super chat, and then you're in on the list, and then we can take a look at your company. We're going to look at stocks and look through two different points of view. My point of view is going to be fundamental analysis, valuing a stock based on its future cash flows discounted to today's value, and also looking at earnings per share and discounted to today's value to see, are we buying that stock at a discount or a premium? And my colleague, Daryl, is going to look at the charts, and that's always incredibly interesting, which reveals what's been going on with that stock. How's the market been trading that stock? What are all the different details there, which is fascinating. And just to kind of introduce the day where we're at today, big news is the U.S. president and the leader of China are on a phone call and hopefully are trying to sort out this trade agreement that is important between the two biggest economies on the planet. And they're also going to probably handle the TikTok situation. As just about everybody knows, TikTok in the US is separate from the mothership that is, I think they're officially headquartered in Singapore, but they have a lot of users in Asia, a lot of users in the US. A lot of people love TikTok. Well, they're trying to figure out, who's going to be the owner of TikTok in the US, and they're going to try to figure that out. In the meantime, looks like the stock market is going to be flat on its open. We have the futures saying that the Dow is going to be up a little bit, S&P is going to be up a little bit, and the Nasdaq is going to be up a tiny bit. We'll see where that goes, and if the stocks hold their gains from yesterday and rally into the weekend. So no earnings today to speak about, and we're going to have to wait until Thursday of next week before we hear from Costco. We're also going to hear from Accenture on the same day, and a couple of other companies, including CarMax. I would be a little interested in seeing what CarMax is doing. And remember BlackBerry. Keep in mind, BlackBerry, about 25 years ago, they were one of the kings of Wall Street. They were one of the most valuable companies in the market, and now they're tiny, and they lost the market to Apple and other players that came out with devices that leapfrogged the user experience, and they're part of history now. It's a fascinating case study that I love to talk about because it's a little bit of, history repeats or history rhymes. It doesn't repeat itself, but it rhymes. And I think other businesses will follow the BlackBerry story if they don't watch it. So those are a couple of things to get started with. I know that we wanted to look at a couple stocks. Before we do that, let me introduce FedEx, because we went deep on FedEx yesterday. Thanks, Daryl, for joining me. And we covered FedEx from all aspects, and I actually ended up thinking that FedEx is discounted by a nice percentage, and also UPS is discounted. Two companies that, are really important to the economy, but have been sold off. And the stock was trading up in after hours yesterday quite well. It was up like 6%, but now it's not doing all that fantastic. That's been a little bit of a surprise. So we'll see where it goes. So let me turn it over to you, Daryl. I think you were going to cover a little bit of FedEx, and then we're going to get into a couple of other tickers that you had in mind.
So I did listen to the FedEx call this morning, and they were impacted by the de minimis rule. That's where importers can bring in stuff less than $800 without having to process it through customs, and that law was changed, or that rule was revoked. So now they had to spend about $100 million building up um, their organization that helps uh, with keeping track of all those tariffs for those low cost imports, because a lot of their small business importers don't have the resources to actually work through that. So FedEx had to build that portion of their business up, and I think it was $100 million headwind against them. I also had forgotten that they had lost the USPS contract, or they didn't renew it. I don't know whether it was a loss or they didn't renew it. But they did pick up Best Buy, Best Buy as a customer, a nationwide customer. So that was a positive for them. Um, so they are facing, general economic slowdown. They mentioned that for their freight business. They're not seeing that recover anytime in the near future. So overall, I think they're facing some headwinds, but I also think they have some positive things in place to overcome them. And the fact that they actually beat by a pretty significant margin the estimates this time, that some of those programs that they have in place are taking effect, and they're managing their business proactively enough to where it might be a good time to take a pretty serious look at them, because
Hmm.
they are undervalued. So that was my take on the call this morning. FedEx jumped up, like Victor said, about 6 to 7%. The implied move was 8%, so it was right at the upper end of that range. But as you can see, they've sold off in the off hours market back down to where they were yesterday at the close. So it'll be interesting to watch FedEx today. Any thoughts, Victor, on
Yeah,
FedEx that I
just
didn't cover?
no, I'm going to repeat this. So sorry for repeating something I've been saying for the years that I've been a YouTuber. The market, is not necessarily rational at all times. In fact, it's irrational often. And when I based on research, based on analysis, I determined, hey, FedEx is discounted. It's going to revert back to its value, and so is UPS. It tends to it tends to happen most of the time, and I think FedEx is certainly a stock that is irrationally been sold off. And I think some of the sell off was rational because their fundamentals did change. But now when I look at the stock and I look at how they've been doing more recently, they had 3% growth in their earnings yesterday. That's very good. This is a big company. In the quarter, they did 22 billion, right? So 3% growth is a chunk of revenue. That's $7 billion of no, not 7 billion, 700 million of growth top line. So all those things to me, like the sell off and UPS is in the same category, I think are creating a pretty good opportunity. Now, FedEx is an industrial stock. It's a very well known company. So is UPS. And as I think about investor types, right? You have a young investor like on the Discord this morning. They're asking, hey, is a 30% rate of return long term achievable? And most definitely it is. Nothing's impossible. It's just probably not going to happen. You can have a nice run of like 3 years and then have to deal with either a bear market or a stock rotation. You know, the market rotated away from the stocks you're in into others. You have to adjust and maybe have a year where you don't do as well. So a young investor should be thinking along the lines of, how can I maximize my rate of return? I'm willing to take higher risk because I have more time. So that's the right place to be for young investors. FedEx UPS is not the first stock I would recommend to my two sons who are 25 and 21. I'd be like, you go dabble with these exciting new companies, the upstarts, the Robin Hoods, the Palantirs. You go find the next Palantir, and that will get you a high rate of return. But the other side of that kind of spectrum of investor types is you have investors that are maybe 45, 55, 65 and are looking to achieve a good rate of return without taking unnecessary risks. They're pretty, you're at a point in your life where you're like, hey, I've accumulated a certain level of wealth, savings, and I don't need to double my portfolio every 3 years necessarily. I want a good rate of return. Maybe you're going after a 10% rate of return each year, maybe higher, maybe 12, 14. And FedEx and UPS would be, I think, a really good idea for that type of portfolio. If you are looking for that type of rate of return, these guys do pay a dividend. I don't use dividends a whole lot into my decision making. They pay a dividend, wonderful. If they don't, who cares for me? I know a lot of other investors feel otherwise. But I think that FedEx and UPS are going to deliver a nice rate of return over the next 3 to 5 years. So wouldn't be surprised if FedEx, we came back 3 years later and it's gone up 30, 40, 50% since from now to that point. So those are things that I'm seeing in the stock, observing based on fundamental analysis, just to give you a glance of where I am on the valuation of FedEx. I think it's discounted by 34%. As I speak, the market hasn't opened, so this is yesterday's price, but it's going to trade up about 1%. And I think that UPS is discounted as well. So I'm actually thinking about buying one or the other and just having a position there. I've been having a great year with my portfolio, thanks to a lot of these small caps that we found that are doing just incredibly well and appreciating very fast. But I would like to have some more stocks that are a little more stable so that when we do have a nice big sell-off, these don't lose as much value. Because if we do have a good sell-off, the small caps that have a lot of growth are going to sell off quite violently, I imagine, if it resembles previous sell-offs. So FedEx and UPS are potentially an investment I'll make. I'm gonna think about it, see how the stocks trade. Maybe middle of next week, I'll make a decision and see which one I'd get into. I also like diversifying into different sectors. And for the industrial sector, which is where these two stocks reside, I don't have a lot of stocks in that sector. I have one. That's not a lot. I have a 3M. And it wouldn't be bad to build a nice position in one of these companies. I think very highly of both of these companies. I think they've been around for a long time. They're going to be around for a long time. They're very well run. They're a part of our economy. They're not going anywhere. They're just going to be a part of our economy. So those are my comments on FedEx. Super interesting. Let's move on to another stock. Did you want to go to Upstart now?
Yeah, that'll be fine. I do want to show my transactions for Hess Midstream. It's going to be a big mover this morning.
Oh yeah, go for it.
Yeah, on this one, up to today, I've had a win rate of 92% on my 25 trades for a 5.05 to 1 gain loss ratio.
Mhm.
So on the trades that I've lost, I've only lost on the 2 trades where it was losing trades, I only lost $75. In the 23 trades, I've made 4,300. And we talked a little bit about this last night, where UPS, I have a horrible win rate. And that was before I implemented the risk management procedures that I have in place today. And we talked about using chandelier exits. Hess Midstream is going to be a really good example of that this morning. So I use these chandelier exits, which are these 2 red lines and this 1 orange line. And typically I draw these horizontal and red lines to match a high water mark on the calculation of that chandelier exit. If the price of the stock drops below those high water marks, then I start trimming. So just this past week, I sold off 110 shares, which is about 16% of my Hess Midstream holding, because the chart was telling me something was going on here. So I trimmed 16% of my portfolio at around between $38 and $39. Today, they are going to open up 10% lower. They're going to drop $3 today. So that's going to put them down about 30, 36 or so. This green line is my cost per share. This lime green is my cost minus any dividends or options that I've traded on a holding. So here's my actual where I would start really losing money. And here's where I would start losing my capital. And I want to make sure I trim or get out of it if there's a big problem before that occurs. UPS, I didn't do that, and I have 100% loss rate. And my thinking at the time was they pay a dividend, they pay a good dividend. I don't care what the price is doing, just keep paying my dividends. But I'm down 40% in that position, which doesn't cover a 7% dividend. So I want to show you a real life example of how this risk management process works, because when the market opens, we're going to have this chart here and we can see it. I'm going to really drop on my winning trades this morning. It's going to drop pretty significantly. But I did save myself at least $300. If it does open at 9% down, I will have saved myself $300 of losses just by watching my charts and trimming my position when it looked like there was something going on that I couldn't explain. Today, we just got news that what's driving it down. So this was 3 or 4 days that I sold before this news came out. And the
Mhm.
charts were telling me that something was going on. So anyway, thought I would just share that because this will be a good example this morning live, that you'll be able to watch those sheets and how I calculate that and why I use that process.
Super interesting. Thank you, sir.
Okay, so let's use IWM first, because it's going to make a little bit more sense when we talk about Upstart. So I don't know how many weeks ago, I looked and found this inverse head and shoulder pattern
Mhm.
on IWM. So basically,
And
you're look.
give me a quick description of IWN. What is it?
It is an ETF that mirrors the Russell 2000.
Thank you, sir.
So it's a proxy for the Russell 2000. And I don't actually hold IWM. I hold SCHA, and that is mirroring the um, S&P 600,
Uh-huh.
which is different than the Russell, which has about is it about 1,000 small caps or so, and then like 400 of them are not even profitable.
Mm.
SCHA doesn't look at the unprofitable. They have to be profitable to be in that ETF. So to me, it's just a little bit safer ETF to hold.
Yep.
But this IWM is the one that's talked about so much that I'm going to use that as an example.
Mhm.
The SCHA, I could draw this same pattern because it pretty much mirrors this for the most part. So a head and shoulder pattern is you look for a pattern that has what they call a left shoulder here. So the price declines and comes back up. Then it drops and creates what they call the head. And then it comes back to the neckline, forms another shoulder. And if that happens, that completes what's called an inverse head and shoulders pattern. Then you draw the neckline between the left or the neckline of the where the left shoulder is up over to the neckline on the right hand side. This one is up sloping, which is good news. When it's down sloping, you have to be a little bit more cautious, but when it's up sloping, it's a little more positive pattern. Then what you do is you just measure down from the neckline to the bottom,
Mhm.
and that'll give you this showed me that it was about a 17.6% drop.
Mhm.
You go to the right or the neckline of the head on the right side, you draw up 17%. It mirrors this downcline, and that gives you a target. Look where we landed yesterday,
Nice.
right where that happened. So these patterns can be somewhat powerful. And I own SCHA. I bought that earlier this year. And then I also bought the TNA, which was it's a 3x leveraged ETF, and I only plan to hold that for a shorter period of time because
Excellent.
it 3x this percentage.
I have a couple questions when you're ready for them.
Shoot.
Okay, so excellent. Now, looking forward, since we are near the target, is your expectation that we're going to struggle to go higher, or uh, or is there a different response to that?
I'm going to watch it closely. It all depends on the economy.
Mhm.
If we don't go into recession and the Fed continues to lower rates, that'll be very good for
And we may
this
get a little
particular.
boost if the US and China, figure out a trade deal. That may be just
Exactly.
psychologically a push forward. Um, so that might be a little bit of boost. But, second part is kind of a statement and it's kind of a yes, no answer or maybe different, response. So we've gotten to a high point, yeah, high point of the Russell small caps.
By the way,
So
this is a 5-year high. So while the S&P and the Nasdaq has had several highs since
mhm,
2020, the Russell is just now getting back to where it was in 2021. So
yeah,
this has had a lot harder work to do.
yeah, I agree. The small caps have, shown short rallies, but not sustained like, the S&P because the big caps have just been incredible. The amount of cap market cap expansion has just been incredible. Like, wow. The top 10 stocks have accumulated so much market cap. It's been incredible. And the small caps have not kept up.
Yeah.
So it's interesting to see this now in my portfolio this year, having the best year of my investing career, phenomenal year. It's these small caps. I have big caps too. I've got, good job, Google. You've really have earned your keep because that's been the stock that I've bought the most of any other stock. And Meta did its thing this year. Nice job. But it's these small caps that are up like 30-40% in a month's time. That's like really making a difference in my portfolio. And even yesterday, Monday.com was up 9.5%. That's a small cap. Well, 9.5% makes a difference in one day. And over the last month, I'm up 20%, maybe a little more on Monday.com. And I could go through 10, 15 small caps that are all performing the last 30 days, 15 to 30% appreciation rates. So my individual kind of stocks are agreeing with your logic here.
Yeah, the RSI is just slightly overbought at the moment. The PPO is positive and getting a little bit more momentum. You can see that in my thumbnail over here. It's actually increasing. I'm looking at I'm looking at the TNA this morning, and it's up another percent in the pre-market. So in 3 minutes, we'll know whether the small caps are jumping up again. But according to this chart, it looks like we're building momentum, and the accumulation is at a 52-week high. So I still feel good about this, and as long as we continue to have a strong economy, the Atlanta GDP now is showing some growth. The Fed and the Fed meeting showed a little less growth in their collective opinion, but not necessarily seeing a recession. So as long as that continues, that'll be good for small caps. And if they can continue on their rate reduction, that'll be good for small caps. Okay. So we have 2 minutes until the open. I want to make sure right at the open that I pull open that sheet so you guys can watch HES midstream. Let's go to let's go to Upstart because it's going to follow this similar pattern. And maybe Mike, he pointed this out this morning. Upstart is not one that I watch, but he pointed out someone else doing another video calculated an upside between $85 and $100. So I just went through a quick analysis this morning to see if I agreed with that. And yes, I agree with part of it, but hitting the lower end of the target. So I'm going to show you basically what I came up with. So here's the left shoulder. You see it here. Here's the head. Here's the right shoulder. So here's the neckline. So if I just go down from there, you're looking at it's actually to the low. So that's about 37%. So then if I draw that up,
Interesting.
then you can see that it actually exceeded that. It's trading slightly below it at the morning or at the moment. This is a pretty defined head, well-defined head and shoulders. There is another one in here, but it doesn't look quite as defined to me. You can see that the right shoulder is much lower than the left shoulder. So to me, this is a bit weaker than one where it's even or increasing. So this one is a little lopsided to me, but I do see somewhat of a left shoulder, a head, and a right shoulder doesn't quite come back to the neckline, so it's hard to say that it's well defined. So if I go to the neckline and go down about 19% and then draw that up 19%, that would get me to about 89. So the other gentleman's calculation was between 85 and 100. I'm getting about 86 to 89.
Mm-hmm. Okay. And I have a valuation on Upstart. Can I show that
Okay,
now?
sure, you bet.
All right. So, all right. So Upstart, from a valuation perspective, I think it's discounted by 41%. If I look at the earnings per share intrinsic value, I don't do free cash flow on banks or businesses that resemble banks, and Upstart does lending. So they're uh, doing net interest margin, they're doing the things that banks typically do. So the I think the fundamentals look good. I think they're profitable, which is very, very good. I think their type of business is something that's going to continue to grow. And, I think banks can probably learn from Upstart that, hey, this is how the consumer wants to, take out loans and so forth. So I like their business type. I like what they're doing. I see your analysis, and, I kind of look at the charts from a very, very high level and think, okay, so the stock hasn't been going up very much, so it's probably not overpriced, and that discount's likely going to be real. Let's take a look at their growth rate and see, are these guys exciting? Well, 53% is an exciting growth rate. Okay, that's an exciting growth rate. Let's take a look at the quarterly. 90% is even more exciting. So I like their growth rate. I like their growth rate. They've had some ups and downs, and it's a young business, right? Sometimes they do something and didn't work. Okay, let's not do that anymore. Let's try something else. They're a young business. They can pivot because they're smaller, founder led, and now they've hit some pay dirt. They're like, hey, we figured out a spot in the market, in the economy, where we really add a lot of value and customers really love our stuff. So that looks good. So that looks good. They're very profitable at the gross margin line because they are providing a platform. Typically, these companies, see their gross margin. These companies are selling off the debt quickly. They're not amassing just large amounts of debt. That would be a pure play bank. They like to amass, a lot of loans, a big loan portfolio, and so forth. These guys are probably selling that off to somebody who wants to buy that and then start to service that debt. So those things look good to me. And looking at Upstart, 14 analysts cover it. Price targets, wow, they're all over the place. The biggest bear is like, hey, this is really overpriced. It's a $16 stock. And the biggest bull is at 108. So they're all over the place. Let's look at their expected growth. They're going to keep growing. And I would say that I'm probably expecting this is going to be better than 27 in 2026 or 19 in 2027 because the last quarter was at 90% growth rate. That's really, really good. And I think that's going to enable them to grow they have momentum in some of their markets. So I think they're going to do quite well in the future. And their earnings per share growth is going to grow really fast. So I think Upstart's looking good. Fundamentals look really good on Upstart. It's a smaller cap, 6.5 billion. So this company could double in market cap, double in stock price, and not make a big move market cap wise, like, let's say JP Morgan would, which is 700 billion market cap. So Upstart's looking good, looking really good. All right, the market has opened. Let me give you the screen. I think you wanted to show something as the market opened.
So let's look at HESM because they had some news this morning. So you can see that they fell out of bed this morning. They're down. It was 8%. Now it's 10.5%. So they've dropped below my capital investment line, still above my net investment. This includes dividends they've already paid and any options that I've done. So now I have to make a decision. They pay a 8% dividend. They've been very consistent over the last couple of years, but do I want to hold this position? So let's go over to my worksheet. And I was at a 92% win rate before this morning, and now it dropped to 52%. My losses are limited to only 297 at the moment. I'm up 2,300, but that's dropped significantly today. And I had trimmed about 16% of my portfolio on 9/11. So right in here, and that's what the chandelier exits were telling me. Something's going on, and sure enough, it took a few days, but here we are, and it had a 10% drop. So now I'm going to have to go investigate this and see whether it's something I want to continue on, or is this an over reaction to the news that was released yesterday after the close. It looks like it may be. We're getting a long tail on this candle right now, saying it may have been a little bit of an overreaction. We'll see. But that's something I'm going to have to analyze and not get in the same position I was with UPS 3 years ago. Okay. Go to Upstart next. Oh, we already did that.
Yeah.
We already looked at that chart.
Yeah, thanks for checking to see if I was awake. Like, wait a second.
It is easy to fall asleep when you're looking at charts like this.
I'm like, whoa. So Mike he brought up Oscar, and I was typing my comment back to him. And so Mike, the dividend investor guy, he is in Oscar. He plans to sell at $20 because historically it loses, pushes and falls back down. Any thoughts? So as you were speaking, I wrote this comment, which I'm keeping Oscar. I'm long because I think Oscar could be a 5-bagger or a 10-bagger for me. And it's going to take a while. It's not going to happen overnight. This thing moves, man, like crazy. I'd love to see your charts on this because this is a pretty wild ride, right? This is like, whoa, look at that. But it's up 44% year to date. What's it doing today? It's up a tiny bit. But as I think about Oscar Health, are they trying to do something that if they pull it off, they're going to make themselves very, very valuable? Answer is yes. The addressable market is the universe within the economy that they want to operate in big enough for them to really expand and make themselves 25 times larger from a revenue standpoint. Yes. So they have addressable market out there. They have a big idea. Now, are they showing me evidence that they're making that big idea work? They're kind of on this journey of becoming, the next United Healthcare, size entity. Yes. So strategically, I'm like, look, Oscar is my ticket to potentially seeing this stock go to 200. I'm not ready to redeem my ticket just yet. Now, I need to be rational at all times. Let's take a look at the valuation of Oscar. Now, part of some of the sell-offs that have occurred is, I think, generally healthcare stocks have taken a lot of heat, a lot of tension, negative news, and all kinds of good stuff. Point taken. Yeah. So, and I don't hold that against the individual companies as much as, hey, that individual company made bad decisions and now they're paying for it. Okay, well, that was their bad decision. It leads me to believe that they may have a problem executing their business plan. But Oscar Health is not that. They continue to grow their revenues. We're going to get to that next. They have very nice cash flows. And in my opinion, at this point, they're discounted by 45%. And I think over time, this line here, this equity line, as well as the value per share, this, if Oscar's successful year after year in making themselves bigger, more important, and therefore more valuable, the equity value is going to expand because, like, hey, we're twice the revenue now. We're driving more cash flow than before. Well, obviously, the forecast is going to be even better. So I think that Oscar has the fundamentals to keep me in the stock. Like, hey, I don't want to sell this stock. They have an exciting future. So let's take a look at the fundamentals within Oscar and see what things am I looking at that are going to enable me to make a decision on Oscar. So the revenue line, this revenue has to keep growing. If this revenue stops, I'm very concerned because they're little. This is little in the health insurance industry. United Healthcare is gigantic. United Healthcare, I believe, is the biggest. And let me open up UNH just to show that data point. When we look at United Healthcare per year, they do $422 billion of revenue. Oscar is at $10 billion. So United Healthcare is 40 times bigger. That's my point of, and are they trying to, is Oscar competing with United Health? No. United Health is a big corporation health insurance company, big corporate, company. They have 100,000 employees. They are the ideal customer for United Healthcare. They're like, awesome. You have 100,000 employees. Here's what we could offer your employees and so forth. Now, Oscar is in a different part of that market. They're going to individuals and small businesses. And individuals and small businesses, they don't, United Healthcare doesn't want that market. It's very fragmented. It's harder to manage and so forth. But Oscar believes that they could do it. And they have a CEO that was the leader of Cigna before they were acquired by, I think, CVS. So he's an industry veteran. So they have leadership that has industry experience with this young talent with technical skills. So you're combining new technologies with good industry knowledge. So can these guys go from 10 billion to 100 billion? In my mind, yes. Are they going to get there? Yes. If they keep growing like this, I really like what I'm seeing there. So I'm following the stock, and this line is one of the most important lines that I'm going to follow is revenue growth. Okay. Now, if they have a little bit of like their profit goes up or down on a quarter because something came up that was out of their control, that's not going to change my position a whole lot. So long as this line keeps moving. So I imagine you're familiar with the law of 72, right? Or the rule of 72.
Yes.
But let me explain it to everybody. So the rule of 72 means you take your growth rate and you divide 72 by the growth rate. And that would mean in years, how often will this company double in size? And at 48%, they're going to double pretty much less than every 2 years. They're going to be bigger. They're going to be 20 billion in less than 2 years. And if they keep growing at these clips, they're just going to keep amassing revenue like they've done before. From 2020 to full year 2024, they went from 390 million to 9.1 billion. That's some growth. It's very good growth. Now they're getting bigger. It's not doable to grow at 109%, but they did do that a couple years back. And I think if they keep growing at these accelerated rates, I'm very good with Oscar. What are the analysts saying? 7 of them cover Oscar. Now, these analysts, right, they're a little bit of, I believe, it's a theory, unproven theory, is that these guys are influenced by the general consensus and sentiment on industries. And I think they're reading the headlines that there's a lot of negativity in healthcare. So they're going to have very low price targets. So that's fine. I'm okay being kind of one of the few people on the other side of the boat. That's fine. So long as I keep seeing those fundamentals. Now, this year here, I am not agreeing with this number. I just don't see it because I read Oscar Health's financials and their earnings, and they're keeping their guidance. So I'm not sure what these analysts are predicting there. And I just showed you their growth is much better than 34. So in this case here, I think this is probably driving a lot of the selling and a lot of the people deciding, hey, I don't want to be an Oscar, but I'm more focused on this line and I'm going to stick to it. So that is Oscar Health. I am long Oscar Health. It's not a stock. Now, we talked about, the different types of investors. You have a young investor looking for the best rate of return, appreciation. I want to take my $10,000 and turn it into $50,000. And what would be the path to get there, the soonest? And then you have some, older investors, 45, 55, 65, 75. They're like, hey, I've worked for decades and amassed this savings, this wealth, and I'd like to sustain that wealth. Well, Oscar Health, I have it in my portfolio, and both of my sons own it, and they're 21 to 25. And this could be a 5-bagger, meaning I'm going to go up 400, 500%, or it could be a 10-bagger. And I do not want to redeem my ticket. I'm sitting on a gain, but I'm not looking for a 10% gain on this one. This one here is a nice big gainer for a while. And again, I just kind of laid out my thesis, which is, do they have the market to keep growing at really high rates? Yeah. I just showed you United Healthcare is 40 times bigger. So that's how big this marketplace is. And the marketplace for individual, health insurance, the population of people that need health insurance that are individuals or small businesses is much bigger than the population that works at a big corporation. So the addressable market is massive. So if Oscar figures this out, they're going to become really, really valuable. So that's my story on Oscar, and I'm sticking to it. Thanks for asking, Mike. And I really appreciate you sharing your plans with it, because I listen to everything, or I read and take into consideration everything you do. But I'm also going to share, what I do, and hopefully I find your comments very interesting, and hopefully you find mine interesting as well. All right. So looks like Mike, I appreciate that, Mike. Little J, how are you this morning? Oh, he brought up Google. Beautiful. Hey guys, Victor, do you really think Google could be the most valuable company in the stock market in the near future? Let's rock and roll. Man, I love it when we talk Google. When Google's up. So Google, I'm going to answer that question, but let's get into the stock. It was a stock that I had mentioned to Daryl as we were kind of organizing our thoughts. And I wanted to cover because it's a stock that earlier in the stream I talked about how the market at times is irrational. It just is taking certain stories, and running with them like if they were fact and almost forming a conclusion and saying, okay, well, this company's no good anymore. And on Google Alphabet, amazingly, the market was recognizing the Department of Justice threat, which was a story. It could have been quite damaging, but it wasn't. It also took into account and said, well, we just don't believe that even though Google's been around for 25 years, just doing awesome work, we don't believe they're going to be competitive in the AI market. Okay. All right. I didn't agree with that. And I wasn't sure what was going to happen in the Department of Justice, frankly. But I did use one example to give me a sense of, high level general expectations. And that's Microsoft. Microsoft in, I think it was the 90s, they clearly broke the law because Netscape came out with a browser and Microsoft used their monopoly to basically take Netscape's business away. And it was proven in court. And it was like, okay, everything was proven. Hey, smoking gun and everything. And Microsoft, basically, the Department of Justice went after them. And then Microsoft battled with the Department of Justice. They battled with the European Union. I mean, it was contentious. Put a period on that. What happened to the Microsoft stock? It continued to go up higher. It's been one of the best stocks to own in the last 25 years. So I use that as a kind of a general, why did Microsoft keep going higher? Because they have great products. They have a great business. They have great margins. They have great cash flows. They continue to grow. Are people going to stop using Google products? Well, speaking for myself, I'm going to keep using YouTube, Google Search, Google Gemini. They've got their Waymo business going. Their cloud business is growing faster than their peers. So all their businesses are looking great. So it's like, okay, well, generally my thesis on Google Alphabet was this is just a really untapped stock. And you see that when we got out of I think April 8th was the low point earlier this year where the trade risk was, the tariff risk was at its worst. But this one kind of crawled out of that period when other stocks were just flourishing. And at this point here on these live streams, member calls, I pretty much said, market's not rational. Google's worth a lot more. This stock is loaded with great businesses. It has very, very good performance. We look at a business that's $371 billion of revenue, adding 13% per year. That's massive amounts of dollar-based revenue expansion. That's basically about 42 billion of additional new revenue being added. And when we look at their forecast, you'll see how big the company is going to get. And when you look at their profitability for being such a massive business, they have good profitability. This cash flow they amass, and this is kind of a low point because they're putting so much money into their data center. $66 billion of cash flow, $72 billion in cash flow. These are just massive amounts of cash flow. And their margins are good. They're knocking on the door 60% for a massive business. Profit margins 31%. So a software stock, you want to add profit 31 plus revenue growth, 13. You get to 44. A good software investment should have more than 40 when you add those two. So we check that box. So I'm looking at fundamentals here that are telling me this business is loaded. It's really, really valuable. Balance sheet's great. Now, these analysts, the comment I made on Oscar, which is they're influenced by all the stories that are circulating. Oh, Department of Justice, AI. And these guys are mixed. So again, on Google, I disagreed with them. But their forecast is interesting, their consensus forecast. If the growth rates persist, they're going to be a $554 billion, $500 billion revenue company in 3 years. So we've got a business that's expanding quite well, incredibly profitable. Now we got the Department of Justice off their back. You have the Waymo business being the number one robo-taxi service in the United States. YouTube, biggest streaming platform on earth, growing faster than the second place company, Netflix. They're growing faster than Netflix. What that means is their car, to use an analogy, is already in the lead and it's traveling at a faster speed. The distance is going to continue to widen. YouTube is phenomenal. The model is phenomenal. Google never has to create one video or one movie or one clip. Everyone that participates in YouTube creates the content. Brilliant, incredibly profitable. Their search business is doing really well. It hasn't let up. And the new a story that came out this week was that the Google Gemini business is now the number one downloaded app for AI on the App Store. And everything with an Android operating system, which is Samsung, Pixel, and a lot of other types of phones, they are optimized for Google Gemini AI. So on the AI side, they are fantastic. So yes, I think Google is going to be the most valuable stock on the exchange. I think I said the next 2 to 3 years. I'm sticking to that timeline. And the fundamentally, Google has a sustainable business, right? It's not like going to the biggest companies on the exchange. NVIDIA is phenomenal, but I happen to believe that NVIDIA doesn't have a sustainable long-term revenue stream. Right now, businesses are willing to buy these really expensive GPUs, super expensive. Like these units are like $30,000 a piece. But what if like in a year, 2 years, they're like, okay, our data center is built out. We're now in the mode of we have our AI built out. We need to start making some money because our investors, our board of directors is saying, hey, you spent a bunch of money, now start making money. We don't want to keep putting money into something that doesn't make money. So I think the revenues are going to, I don't think, be there for NVIDIA. Microsoft's in a better boat, but I don't think Microsoft's products are as exciting as the ones that Google has. Apple is on its way down. Their iPhone releases are not exciting. I think they're vulnerable. I think the BlackBerry story and the Apple story are going to rhyme someday. That, hey, the market moved on. AI doesn't have a very strong AI play. There's not much excitement in Apple land. But look at here, Google. They're up 33%. They still have a PE of 26. That's lower than the three ahead of them, especially NVIDIA. And NVIDIA, again, I don't think they have a sustainable revenue model. I think their revenue is going to really be challenged. So these guys, if they move to a 35 PE and just get in there, mix it up with their peers, let's say you apply to 37 PE, right? So we're going a P of 37 there. I think they caught up to Microsoft and then they just have to bump up a little more, and boom, they caught to NVIDIA. So I think it's a rational expectation that Google would get up there. I see Big House Juice is asking about Meta. Meta's too small to take the title. If you look at their revenues, they're quite a bit smaller than Google, quite a bit smaller than Microsoft, and I think they would. I think they're going to be phenomenal, top 5 stock from a valuation standpoint. I own them, biggest position in my portfolio, but I don't think they'll be the biggest. And the Google in the current year has, really just been a really good winner, and is a good reason why my portfolio is really, really doing great. Because, if all the naysayers were like, Google's just, a bag of rocks, they missed. They had it wrong. 69% rate of appreciation since the lows. And I was buying. I was buying here. I was talking about it with you guys. I was talking about it and buying it. But I don't know if you guys were buying my story. You guys were like, man, I don't know. Google, I don't know. I bet some of you felt that way. Some of you were like, hey, that makes sense, but not to like create any tension between us. I'm just saying, this is the moment. These are opportunities. We got to like think. We got to think kind of like when something's happening, we got to kind of say, okay, let me agree with the market and kind of follow that along and see if I could substantiate what the market's saying. Okay, is Google going to be broken up? Hey, is AI going to be the biggest threat to Google, and so forth? So I kind of try to build that story, but I thought the more credible story was, no, the market's wrong. Google's been proving themselves for like 27 years. They went from nothing to the number one, search engine, and then they built other businesses. The culture is one where innovation is just constant. They don't stop. They don't stop innovating. They just keep, pressing forward. So that's Google. I love talking about Google because I want to go find this situation again. And I think we talked about UPS, right? I'm seeing, smelling, feeling similar to what we've been talking about with Google. What's going on here? This is a business that is really important. It's expanded over the last, 4 years. Important part of the economy. It was a $240 stock in 2021, and now it's an $84 stock. Okay. The analysis shows me that this stock was discounted 38% before the market opened. And this is beginning to feel like the market's irrational on United Parcel Service. Thinking about buying some shares, and this might be a position that I take. It's not going to be a giant amount of capital, but I think it's a logical investment because I think the valuation is there. I think the market is not seeing this stock right, and I'm willing to put my capital behind it. So I went a little long, but sorry about that. Any thoughts there on Google?
Yep. I'm long Google and building my position there. I started on May 9th because I had pretty much come to the same conclusion that you had. I've only built 45 shares, but I have an average cost of 169, so I'm up about 50% so far.
Nicely
So
done.
I'm gonna keep building this one. Let me try to catch up with you. Oscar, whenever we look at these charts, you always have to keep in mind these are short term. I'm only looking out, maybe a week to a month on price changes and patterns, maybe 3 months at the very extreme. Let's step back and look at a longer term chart of Oscar. And I do this once per week on every holding that I have. This is a weekly view with 3 sets of moving averages, a 21, week versus 34-week, a 5-week versus 13 weeks. So that's basically a quarter. This is almost a year. So this is a yearly view. And this is 1 week to 5 weeks. So you're looking at basically a month. So then I like to look and say over the next month, Oscar is strong in the short term averages. Look at it in the midterm averages. It is strong and getting stronger in that 5 to 13 weeks. So you're talking at least a quarter. And these are weekly averages. So they're a lot slower than daily averages and kind of get rid of some of the daily noise. Then we look at the long-term averages. So now we're looking at a year and it is also strong. So I can say with some confidence that for the next year, just ignore the daily noise because it looks like they are on an upward trajectory for price. When I come back to this chart, about the best I can do is see that the next target's around 21. But I like these charts because this slows everything down and I can look out almost a year with these kinds of charts. So I wanted to use Oscar as an example.
Great. Excellent. And then, so I'm going to answer a question kind of out of order. James asked, how much dry powder am I keeping these days? And I'm mostly invested. I'm like 3-4% in cash, but I would say that I'm selling some shares, moving that to more like 5%. Is it going to go higher? Maybe higher than that, 6-7%. But I'm not touching things like obviously Google. I'm not touching Meta. I'm not touching Robinhood. I'm not touching Astera Labs any longer. I did sell some Astera Labs, but I am selling like stocks like PayPal. Lowered my share count. And the reason for it is at some point we're going to get a sell off. It's just not achievable to see the market just go up and up and up and up. That just doesn't exist. But just wanted to answer that question. Back to you, Daryl.
I think there was a question about gaps.
Mm-hmm.
And when that question was asked, I was looking at the Oscar chart. So these gaps are when the price, either gaps up or gaps down on a day. And he was asking me whether I look at those. And yes, I look at those. I respect gaps, either gap ups or gap downs, because they do often get filled. On Google, he asked about that specifically because there is a gap at about 212, jumped up to 226. We often see these gaps get filled over time. So we saw a gap here and it took a while, but it did finally get filled. And you had another opportunity 3 months later to get back in. Here's another gap up and then a big gap down and the gap finally filled. So I haven't added to Google in a while. So keeping an eye on this gap here, we could actually get that filled at some point, either in September where we're seasonally weak for the technology sector. It could be pushed out until October. So I would love to pick up some more Google, but I mean, right now it's running up really high. It's way overbought. PPO is at an extreme level. Accumulation is at an extreme level.
Man, RSI 85. Holy smokes.
So it is really extended right now. So to answer that question, I'd love to see this gap get filled over the next couple of months.
What does that mean? This gap gets filled. That means the stock goes down or up.
It depends on whether it's a gap up or a gap down. So this was a big gap up right here.
Mhm.
Let me zoom in here.
Yep.
You can see that big gap. And it took months, so it kept running up, ran up, started coming down, but finally it did get filled. So if I come clear over to 3 September, the price finally, and I'm pointing at the screen, which makes
Mhm.
no sense for you. But if you follow that gray line across, you can see that that price finally got back down to
Mhm.
that gap.
So that gap
So
fill means that at some point you expect Google will the stock price will go down
I
like it
ex-
did in the past.
uh, that's my hope and my expectation. I mean, we can't keep running like this forever. We haven't seen very many charts where it goes more than a couple of months in an overbought condition.
Unless
It,
you're like Palantir.
yeah, it could level out, and that might also be an entry point if it doesn't look like it's going to fill this gap. But a lot of times they do. Sometimes you just have to be patient, wait a month or two. So I'm waiting to add more to Google, but I'm not adding at these current prices.
I have Google discounted 9% from their intrinsic value to their current stock price.
Yep.
But I agree with you that we've had a terrific couple of months on Google shares. Can it keep screaming up? The answer is it could. Is it likely to do so? No, I think if we have a nice stock market correction, all stocks are going to kind of see their prices, go down as we have a sell off. And I don't think Google's going to be exempt from that. So we should see some pullbacks. I don't know when.
One of the interesting things when we were talking about Google, and I think they were probably hesitant uh, with their browser to make many big modifications.
Right, right.
But I don't know if you've noticed, I can go to the right hand corner of my Chrome browser,
Well, let me
and
move
it
our
and
faces.
it
Give me a second here. Let me move our
yeah,
faces because there we go. Go ahead.
and it pops Gemini up right here.
Yeah,
I don't even have to leave the browser anymore.
big advantage.
Yep, it's
Yep,
huge because with Grok, Chat GPT, any other uh, AI that I use, I have to leave
correct.
or I have to create a new tab and what have you. Here, they built it right in. I just saw this.
Yep,
They also built it right into uh, the Apple operating system, which you would think Apple would be the one to do that. But here's, I don't know if you can see my icon up at the top of the screen, but Gemini is right there. All I have to do is scroll up and press that
yep,
button. Gemini pops right up for me to ask a
exactly.
question.
It's and I've been using Gemini quite a bit. I also use OpenAI, ChatGPT, but God, man, it's getting really good. I and then I have like these really interesting conversations with my 21-year-old that is a big ChatGPT user. I mean, the guy has been telling me for 2 years that the world has changed and I need to come to reality or come to terms with it. And he's doing some really cool things with ChatGPT. And I'm like, I've used it, but I think Gemini is fantastic. I think the user experience is great. The answers are accurate. I've been using it for my analysis. I used to go dig numbers out of financial statements. Now, I would say on important decisions, I still go to the financial statements. That is just not gonna. I don't want an AI system to have a hallucination, and I've got $100,000 on a stock, and it's because I had bad data going into my analysis. Yeah, I don't want that. So I go to the financials. And maybe someday they'll have a super accuracy rate, and maybe at that point I'll trust it enough. All right, we covered Google. Is there another stock you wanted to cover? Or
I
Can
was
we move
just
on?
I was just pulling up HESM again real quick and see what it's
Okay.
doing, but we don't have to look at it. It was just for my own edification.
While you do that, I'll repeat something that Mike is saying. Keep an eye on Fubo. Interesting. A lot of mergers in the whole media space, huh? We had Paramount. Now it looks like Warner Brothers Discovery, Fubo. Interesting.
Yeah, I haven't
So we
seen any announcement on Warner Brothers offer from Paramount yet. I keep watching for that.
interesting. So were you going to say anything else on this?
Nope.
All right, let's move on here. See some comments. Good to see everybody, by the way. Ben 10, Little J, James, Mike. Okay, so it looks like we've answered the call. Big House, good to see you.
We were
Carlos,
gonna
great to
look
see you.
at Novo,
Yeah,
ASML, Monday, and TMDX.
great. Let's
If
start
you
with
have time, I don't know if you have
I
time.
do. I do. Let's talk a little NVO. I'm liking what I'm seeing in NVO. Today it's flat, but I'm seeing this. Okay. Have we found the question that I would like you and I to let's do our analysis and then conclude with our individual answers on have we found the Nova Nordisk bottom? Do we see the bottom and say that's probably going to be the bottom from here? It could go up, it could go sideways, but I think we've achieved the bottom. So year to date, this thing's down 28% over the 1 year. It's pretty bad. Now, some things caused this, right? Just there was a shortage of these weight loss drugs, so the FDA said, okay, well, if you can't produce enough, we are going to allow others to produce it and sell it, because if you can't produce a drug that people need, we allow that. And then finally they got their production up to speed and they're like, no, we can produce all the drugs. But now they have a lot of other businesses that are selling weight loss like drugs, or maybe even versions, or let's say drugs that were inspired by the Novo Nordisk weight loss drug. And that's been a pretty ugly situation for them. But it's just a really discounted stock. I'm going to show my evaluation in a bit. And looking at this, we were at $45 a share on August 6th. Now we're at 61. The stock's been performing for over the last month, and it pays a dividend. The P ratio of 15, forward P of 15. I mean, those are really nice. Analysts think it's discounted. It's discounted quite a bit, according to analysts. And the business continues to grow. This is a big business. This is in the Danish krona. So we're not going to focus on this number. Just know that they're a very big business and they're growing at 21%. That's very good growth. So very, very good. Profitability is extremely high. This is a pharmaceutical company, and these pharmaceutical companies, once they have drugs that have been completely, discovered, put through the FDA approval process, and have become commercial successes, extreme profits, 84% gross margins, 35% profit margins. These are beautiful numbers. And free cash flow at 21%. So just glorious, beautiful numbers. And the stock price is beaten down big time. Only a couple of analysts are covering this stock. That's a surprise because it's a big cap. They're going to keep growing. Now, I don't agree with this forecast. I think they're going to grow better than this, way better. And I think that their profitability looks good. So overall, I think Novo Nordisk was one of those stocks again where I'm like, market, I think you're taking the stock way too low. I agree they had their challenges, but maybe they could have gone from 142 to 100. Now it's like, this is a very well-known company. And what is my valuation on Novo Nordisk? I think they're, as I speak, 31% discounted. That's a nice discount on a very well-known company with very successful drugs. So I bought some Novo Nordisk, not the biggest position in the world, and I haven't been able to buy shares in probably a couple of weeks because the darn stock price keeps going up, and it's always kind of, whoa, I'd love to buy on a pullback. Say so. This one here is, I don't know if it's set to go much higher. I think it is going to go higher. Is it going to? I think it'll go back to $100 a share, and then try to figure itself out from that point. But I think it's a solid investment as we think about young investor versus older investor that wants to take risk and try to achieve high rates of return versus older investor that wants to kind of be wise in protecting capital while achieving a good rate of return. I think the older investor is probably this is probably a good idea for an older investor. It's a little riskier because you're playing the rebound, but I think the numbers are there and it pays a dividend. So I'm glad I bought Novo Nordisk, and I think that we've seen the bottom, and we'll see how high it could go. So those are my comments on Novo Nordisk. What do the
Let's,
charts look like?
yeah, let's take a look at the chart because I just redrew these lines, but and I'm going to save this because we can come back to it in the future. But I redrew these lines. So these dotted lines is showing a long-term downtrend. So I'm trying to connect as many tops as I can connect to give me where a price target would be for a reversal. And then I drew a shorter term downtrend and where we might see a reversal. So I think we looked at this either Monday or maybe last week when I drew these lines. I didn't save them, but I redrew them pretty much exactly like we talked about them. And now I'll save them so we can come back to it. They are on a long-term downtrend. The 200-day is definitely declining. But when we drew these lines, it had yet to break above this, but look what it's done in the last 2 days. So it's broken this short-term downtrend, which is good news. The next step was, can it break this longer-term downtrend, at least from December of last year? And if I took the chart out a little further, we might be able to drag that back. It is going to face a little bit of resistance at the 200-day, but if it can break above that, then the 200-day will start trending back higher. And then it could just start resuming its upward price movement. We are sitting in an RSI of right at 70.
That's good.
Yeah, the PPO is positive. We did lose a lot of, or there was a lot of distribution when whatever happened here, probably some earnings announcement or, some drug announcement. I don't know exactly what happened, but a lot of distribution right there. But it's kind of like when I'm,
Yeah, they
me and
had
my,
an oral version of their drug, and it's showing it's really successful.
yeah,
So,
that's been here within the last couple days, right?
mhm.
Yeah. So
Yep,
that's
that was
what's
this week.
causing,
Yeah.
yeah. Now I am seeing, there was a little bit of indecision in yesterday's trading on this gap up.
Mhm.
And today there seems to be maybe a little bit of reversal. So we'll see that if the price comes down over the next few days. But if the news continues to be positive, I would expect this to continue climbing.
Very good.
It's kind of like when I was my wife and I like to cruise, and when we were in Alaska and we were in the ice caps, everybody would, 3,000 people on the ship, they'd all run to one side of the
Right, right.
ship. And if you happen to stay on the other side, you didn't have as many people and the view was almost just as good. So people run from one side of the ship to the other, and then as things stabilize, people disperse throughout the ship, and it's kind of like the stock market.
So I have a request for you, sir. And Sam, sorry I was a little slow to get to your comment, but Sam wanted to see if you could take a look at the TMDX chart.
Okay, I'm not familiar with this company.
This is Transmedics Group. They are a commercial stage medical technology company in transforming the organ transplant therapy for end stage organ failure patients.
Okay. So I'm seeing the formation of a cup and handle. And typically the way you measure out is you look at the edge of the cup, measure down almost like the inverse head and shoulders. And then your price target would be about 60% above this right edge of the cup. So I won't be able to drag that up that high because the chart doesn't go up that high, but just add 60% to this price of 140. That would be my next price target.
Wow. That's pretty optimistic.
If the fundamentals support that. It looks
Mhm.
like it's been on a nice drive over the last 5 years,
Yeah,
but we did
looks
have
really
this
good.
big cup and handle, and it's big. That's several months.
Uh-huh.
How do the fundamentals look on this one?
Yeah, let me take a look.
That 60% is not gonna happen tomorrow, it's
Well, Saturday, but
yeah,
how about Monday?
okay.
Oh man. It's Friday, little humor. Sorry about that. All
Yeah,
right.
that base looked to be about 3 or 4 months, so I wouldn't expect any kind of price change like that until within, 3 or 4 months.
All right. So let's take a look at Transmedics. Start here. So this company, it's got, like you mentioned, it's really been exciting, and investors that were early most definitely are doing great. But you've seen these pullbacks, quite drastic pullbacks. And this is what was the cup and handle you were referring to. This is a $4.26 billion market cap company with their revenues are already 531. PE is high. And analysts are saying that it's fairly priced. The growth is very good. Um, it's a high growth rate. It's a small business. The free cash flows have not been great to this point, and their gross margins are good, but they've been coming down a bit. You see that they went from 70 down to 60. Profit margins have been good. For a small business, these are good profit margins. But their free cash flow hasn't been great. And this company, keep in mind, within this area of small cap healthcare, there are a lot of terrific choices. Terrific choices. So when you look at my valuation, you know, I think Transmedics is priced too high. They don't produce a lot of free cash. And my best forecast, which is quite aggressive, is not that great. So I actually think it's priced too high looking at fundamentals. Let me look at their forecast. So this is beginning to worry me on the stock. Is it's becoming a slower grower, and it's being priced as an incredible growth company. So taking that into account and putting that into my forecast of cash flows, forecast of earnings, I just think the stock's priced too high. So that's where I end up on Transmedics. All right. We got a super chat sponsor. All right. Thank you, Malt Maltlicky, Texas. Good to have you. And you'd like to look at Lululemon. Let's do it. And I spent my summer in Texas in San Antonio and visited San Antonio was cool. Nice people. Visited Austin, Dallas, Fort Worth, Houston. Was really impressed with Houston. Really clean city, nice people. Went to a ball game. Really good trip to Texas, and I spent 11 weeks there, so got to know Texas. All right, so let's talk about Lululemon. I am a fan of yoga, but I do not wear any Lululemon apparel. These guys have really been sold off over the 5-year, 42%. And this, I mean, if you went back 15 years ago, these guys were just growing like crazy, but they have gone from a $511 price, stock price down to 169 since the end of 2023. So the last 2 years have been kind of miserable for investors who have lost a lot of their investment. It's relatively a small cap, revenue of 10.9 billion. PE looks really low at 11.5. Forward PE is 13.79. Analysts think it's discounted. Now, a company like this, revenue growth is really, really vital. Now, let's take a look at the quarterly. They announced their earnings so September 4th, so 2 weeks ago. And so this is their fresh earnings, 6.5% growth. They have been slowing down on the growth rate. Now, some of that is because the number keeps getting bigger, so that's understandable. Their Q4 looks like their last Q4 was very good around. That does include the Christmas season, so that makes sense. So this is pretty decent growth, very decent. It's trending down on the growth rate, but that's expected if your number keeps getting bigger. Profit is pretty good for an apparel company. It's actually impressive. Almost 60% gross margin. Profit margin 16%. Free cash flow 10.7. The forecast, we got 23 analysts covering it, and some analysts are really high on the stock. And the worst case scenario isn't too bad. $160 price target. So we're not far from that price target. The company is going to keep growing, okay? And their profits are going to keep growing. So it looks good. And their PE is going to keep dropping. So this company's looking good. You know, from a business perspective, I think their brand is like they're the leader in the whole yoga apparel. And as I'm sure we know, everybody knows, is outside of yoga, people really enjoy the apparel because it's very comfortable. Got it. Especially to wear around the house. It's like, you know, apparel. I feel most comfortable watching football games in my gym shorts and a t-shirt, but I wouldn't go, you know, to the movies wearing that. All right, so let's take a look at the valuation. And I'm showing that Lululemon is discounted by 26%. All that makes sense to me. This is a well-known brand. They are going to continue to drive a good price. I think they have pricing power because people want Lululemon, the brand itself, right? I mean, branding is so important in apparel. You know, like I don't own any, but like brands like Gucci or, you know, you name that premium brand, they charge like $5,000 for a purse or $1,800 for a purse. And you could go find a purse of equal function for $30. So It's like, whoa, that brand really makes a difference, right? And the brand around Lululemon is still, I think, really positive with ladies. I talked to my wife about Lululemon and Lululemon stock. She kind of gives me her point of view, and I think she has a very positive, feeling about the brand. So this is a stock. Now, what kind of investment is this? If you're feeling like this stock's going to revert back to where it has traded in the past, it's a very well-known commodity. They don't pay a dividend. But let's say this thing's going to revert back to $300 a share. You almost doubled your money. And 300 wouldn't be all that high. So this would be a logical bet for somebody who, just felt like, hey, I don't own an apparel stock. This wouldn't be a bad, risk to take. I think the stock's gotten to its lowest point. Fundamentals support a higher stock price. They are growing their business. It's not like, hey, they're contracting on their revenues. No, it's not the case. It's actually expanding quite nicely. So Lululemon, I think, I thought about buying Lululemon. Didn't pull the trigger. I don't know that I want to pull the trigger just yet. But I look at the fundamentals and think I don't own any apparel stocks. I don't know that I want to own a whole lot of apparel, frankly. But if I wanted to buy an apparel stock, this might be one of them. So those are my thoughts on Lululemon. What do you think, Daryl?
Look at some charts here. So we were asked to look at Wendy's last night.
Yeah.
If I took the name Lulu off this one, you'd think we were looking at Wendy's. So they're trading at 160, and that's almost their COVID low. So that looks identical to the chart we had last night for Wendy's. So let me go. This is a 10-year chart. They did have some phenomenal growth over that period, but they are not looking very good at the moment. So let's step out to 1 year. I'll add similar trend lines to what we were looking at earlier on another stock. So we have this trend line here. This longer term trend, the price would have to get to about 267 before it breaks out of that downtrend. If we look at a shorter term trend, it's going to have to break out somewhere about 183. And I'll tell you what my philosophy is on these. I'd rather pay $234 for it when the price is going up than I would $160 when the price is going down. That's generally the way I look at it. I'd rather pay a higher price when the stock is already in an upward movement. So right now it is not in that configuration. It is in a downward decline and hasn't shown any sign of breaking either
So
the short-term
question.
downtrend or longer-term downtrend.
Okay, here's my question. So a stock can't go past zero. We would agree on that, right? The zero is like the lower limit. So this stock went from 500 to 160. And it's basically the charts that I'm seeing is what's going to go to zero. Well, that's just irrational. It's not going to go to zero. At some point, this thing's going to attract guys like Michael Burry. They're like, oh, Lululemon's too cheap. The brand's too good. And they buy. So I respect that you don't want to buy when a stock is on a downtrend, which I've heard from other successful investors. Totally get it. But there's a little part of me that loves picking up stocks when everybody hates it. Everybody ignores it. It gets taken out with the garbage, and you go sift through the garbage and you go, whoa, hey, look at here. I just found a Rolex watch and it's real. Hey, I'm going to go sell it. And you're like, wow, somebody put a Rolex watch in the garbage. Maybe they did it accidentally, but here we go. I just made, very good return. So I think I guess it's not a question. It's more of a, different fireworks go off in my mind when I see a stock chart like that. I'm like, huh, man, it just keeps getting better. I mean, the market keeps lowering Lululemon's stock price. I love it when the market is irrational and gives me these fantastic discounts. So maybe if it goes down another few percentage points, I might jump in there. Right now, Lululemon is flat. It's not going up or down. But anyway, I'll just state that hey, maybe, and it's okay for us to be different, right? We should be
Yep,
different.
exactly.
And I'll just put it out there that, different fireworks go off in my head when you show
Yep.
a chart like that.
So what I did was I went to weekly data, and I'm going back to before the company even started. So they started in 2007. So I could actually draw this trend line probably all the way back to there if I wanted to. But I'm respectful of these long-term trend channels. So what I've done is I drew a line connecting as many lows as I can, make a copy, drag it up, and connect as many tops. So this is 20 years worth of data. And you can see that it stayed in that trend line or trend channel until May of this year. And when they start falling out of a 20-year trend channel like that, it's just not for me. It's not one that I want to step into until it starts showing some recovery.
Yeah,
Uh,
very good analysis.
so I can show you one exactly like this. Let me go to analysis, and because I did this 2-3 years ago for some Nike investors who
Whoa.
were pushing Nike so much, and you can see that it fell out of a 15 or 20-year trend channel, and it has not recovered. And it is in this is weekly data. So we're looking at a 200-week, 5-year trend line. It is going to take months to turn that trend line around. So, yeah, I'm not arguing that it's a great value, but when I look at 25 years worth of data, I'm not going to step in.
Yeah, very good analysis. Thanks for sharing that. So, Malt Licky, Texas, thank you for the super chat. Hopefully, you found the analysis interesting. Thank you. All right. So, we've got a couple of new comments. And for algorithm,
Here's one on Costco.
uh-huh.
This is a 15-year, 20-year trend channel. And you can see that it's still in that trend channel.
Yeah. Yeah. Costco reports Thursday.
Yep.
Of next week. All right. So it looks like for algorithm had a question, and Oscar has more revenue than market cap. Is that normal? Yes. In health insurance payers, it's that's the reason, because they don't have very high margins, so they have to have high revenue. Same thing with United Healthcare, Elevance, and companies like that. All right. So can we move to the next stock?
You bet. I'm just going to save this chart because Lululemon's going to come up again and again. So I'm just going to save this.
So Big House is keeping an eye on Fortinet. I like Fortinet. I did I did research on cybersecurity, and the last time I went deep like that, I found Zscaler, and I made really good return on Zscaler because Zscaler was being priced too low. And this time I did this, and Fortinet was what I thought was the best opportunity. And I started buying into it, and it's, doing good. It's going up. And it's good to see it go up. Today it's up 4%. Look at that. That's good. Was there some news on it? Maybe. And again, these are like when we deal with cybersecurity, it's most definitely a necessity, but the competition is real. It's not necessarily like a winner take all kind of market. That would be like Adobe has leadership in their space. Salesforce has leadership in their space. Microsoft has leadership in certain spaces. But when it comes to cybersecurity, it just constantly evolves based on what type of intrusion and risks there are for cyber. And these guys were really sold off. Their guidance was a little bit lacking confidence, but you think about there's management teams that operate differently. The CrowdStrike management team is like, oh man, we're going to do so great. And you study their fundamentals and you're like, okay, your fundamentals are not great. So CEOs are paid to sell their stock, sell the vision, sell how they're going to get things done. The fundamentals tell me the real story behind the company. When I look at the fundamentals for Fortinet, the fundamentals are good. Good sized company with good growth. They have good margins and they have good free cash flow. Free cash flow, $2 billion. Profit margins of 30%. When you add 30 plus 14, you get to 44, above the software metric that you want those two. When you add them up to be above 40, we are above 40, representing a good investment opportunity in a software stock because they have high margins, high cash flow, growing. So this one here presented itself as the best discounted cybersecurity stock available. Started to buy into it. So far, so good. To show you the valuation. And there's a video on my channel that you can watch if you're interested, where I compare a good number of cybersecurity companies. This one, as I speak, is discounted at 32%. Compared to others, Zscaler now is priced too high, but I caught it at the right time in 2024, made a very good return, got out. CrowdStrike is very overpriced. And that one is just, it's a darling because I think its CEO does a nice job of selling the stock, but I don't buy stocks to buy a CEO. I buy a stock because I'm buying free cash flows. And look at this cash flow line. 1.3 billion, where Fortinet is already at 2 billion, 2.3 billion. They're just more valuable because they have better fundamentals. And CrowdStrike's growth rate is slowing down. They were a 40% grower. Now they're down to 20, and they're smaller than Fortinet. So Fortinet's 13, 14% growth represented in dollar growth is higher than CrowdStrike. So it was a good opportunity. And this is why I love investing. We're in a way we're kind of archaeologists, forensic, investors. In my case, I like looking for quality that is misunderstood. And I have a particular thesis on it, and then I follow it. And then when it begins to come together, it's very encouraging and fun to watch. So that's Fortinet. Thanks for asking about Fortinet. All right, I think I covered Fortinet. Did you guys hear about Intel's pump the other day? Yeah, absolutely. That really caught my attention. Intel went up because they're going to partner with NVIDIA. NVIDIA is going to invest $5 billion to co-develop things with Intel. I'm taking higher positions in VRT. I think there's room for growth. All right, good luck. Let's see I don't remember what VRT is. So Vertiv. Oh yeah, this one's so you probably seen my research on Vertiv, and I don't think this stock is discounted. I think it's priced at a premium. They are in the data center, if I recall, and I have a alternative opinion on this one. I'm not a buyer, I'm a seller on it. And you can take a look at videos I've done on Vertiv if you're interested in that. So I don't know if this is a question you can answer. Would you consider a head and shoulders on Lulu's 1-year chart?
I
I think
looked at it and I didn't see anything that was very well defined. So you could probably find one, but it didn't look very well defined to me.
And thanks again, Maltlicky, Texas, for the super chat. I'm glad you found the analysis interesting. Please come back. Please consider being a member of the channel. It'd be great to have you. So software stocks are beginning to rally. I agree with that. Let's take a look at the heat map. I was looking at it a little earlier, and you've got a little bit of green in the software space. Intuit. I hold Intuit in a very high regard because I think the TurboTax software is very recession proof, because if we're in a bad recession, you still got to do your taxes. Small businesses that use QuickBooks, they're not going to stop doing their books. So they buy into businesses that are very resilient. So the pullback on Intuit has been an opportunity. I've been buying into it. Uber is up. I don't think they're a software play. I think they're an industrial logistics company. ServiceNow is up. CRM is flat. Adobe's down. So I think in general, I agree with you that some software stocks have really been moving up. So that's good to see. Looks like Amazon is up. Google's up a little bit. Are we in the red now? Are we in the red here? No, we're still in the green. Why are we in the green? I'm seeing a lot of negative stocks. Let's see here. So the Russell's down. These are up. Okay. This heat map would lead me to think, I guess the big stocks are doing well. So that's what's propping up the market. That makes sense. Okay. All right. And then here's a question. Do you stay away from IPOs? Yes. How about you, Daryl? Do you stay away from IPOs, buy IPOs?
No, I do not.
Yeah, they're just too risky. I like seeing a company give us a couple of earnings announcements, and not a perfect science, just an observation that most IPOs sell off, no matter the quality of the business. Reddit, Astera Labs, more recently, and I just don't want to buy too early and then boom, I'm dealing with, I'm down 40% and I have to wait a while before I'm in the positive. So this is a stock that Peyton is bringing up, Netscope. Netscope is redefining security and networking for the era of cloud and AI. We built Netscope One, our unified cloud-native platform, from the ground up to solve the challenge of securing and accelerating the digital interactions of enterprises in the new era. Okay, so it seems that this is a very useful technology in today's age. So I think there's definitely demand for this. Okay. The stock, when did it IPO?
Like 2 days ago, it looks like.
Yeah. So let's take a look at the fundamentals. So it IPO'd, it has a market cap of $9.49 billion, revenue of $615 million. Depending on growth, that may not be outrageous. So they had 32% growth compared to 2024. And that's good growth, but it's not incredible growth. it's good. Looking at the quarterly, again, good growth, not incredible, but good because they're new. They may be selling, how big's their addressable market? Who are they competing against? Is their competitor going to come out with a new release that's going to be better than Netscope? So there's just a lot of things that are going to be challenges to them. And it would be too early for me to think about investing in these guys. Let's look at their margins. We could watch the stock and maybe at a later date get more serious into the stock. They do have good margins. Looks like they're at about 70% margins, and they're small. That could really expand. As they get bigger, they get more efficient and they do better. They don't have free cash flow yet, but they're really moving toward positive free cash flow. They went from 144 to negative 20. And I think if we go to the quarterly, we might see positive numbers. Yeah, here's a positive number. So that's very encouraging. That is very encouraging. Now, if we if we follow this stock, this may be a nice little investment, right? The other company that I followed and then I bought into was Astera Labs, and this has been a successful investment. These guys IPO'd, stock rose, it faltered. I bought, boom. Very, very good investment. 200% appreciation in less than a year. This has been one of the best calls that I've had here in 2025. This is in the same space, connectivity. And this company is more software, but they're doing networking. So similar space. This is the semiconductor that enables data centers to communicate, one data center to another data center, and that's really important. Astera Labs is selling off today, 7%. I'm not buying any shares. I think the stock's priced too high. You don't go up, you don't go up a couple 100% in 4 or 5 months. And it just went up too fast. I sold shares somewhere around here. I sold about a third of my position. I still own a pretty good position in them. It's a high risk stock, but this is the kind of stock for the young investors. When a business is growing at 163%, it's pretty good stock to pay attention to. 242%. Back to these guys, right? That's why these numbers are not overly sensational. 32%. Okay, that's good. That's good. But if you want to be great, you got to show numbers like these. And you got to show numbers like that while you produce positive free cash flow and you're profitable. There's a lot of ands on Astera Labs. So this thing just set itself up and it's like beautiful. Don't you love it when the market's irrational and takes things out to the curb along with the garbage they're throwing out? You go, hey, this is a beautiful stock. Boom. So this guy, if we can get a couple more earnings, maybe it ends up, going from 25 to 15. We get more financial data. We see that they're actually going to grow faster and we snatch it up if that ends up playing out that way. So on IPOs, is there anything on the charts that is interesting to look at?
No, there's only 2 days worth.
You'd have to look at.
Yeah, there is something interesting to look at Fortinet that I'd like to share when you get a chance.
Okay, let me finish on Netscope and then we'll go over to Fortinet. So yeah, so this one here. So, and I think it's Peyton that asked the question. So you're looking in the right area. You're a younger investor. Hey, I want to find a technology play that is really going to be exciting. It's just, be aware, like, okay, I'd like to see their growth expand. mean, show me a nice 60 or 70% growth rate, and then I'll be like, okay, these guys are special. But if they go from 30 to like 10, okay, they're not special. It's like these guys are not gonna create a big enough revolution to pay attention for me. And a younger investor should think even more aggressively. You know, would I obviously you want to find this situation. Okay. Let's go find situations like this and then you jump in there and see the value. Reddit presented itself like this. Here's another IPO story. So Reddit IPO'd last year, March 21st. So we've been dealing with a publicly traded company over the course of a year and a half. It really got drummed up. It got sold off. Yours truly started buying Reddit hand over fist here. And I'm sitting on a beautiful gain. The market will get irrational. The market will do this over and over again. Not to every stock, but boy, Reddit is an exciting company growing at 70%. That's exciting on a pretty good sized number. Their gross margins are beautiful at 91%. They're already profitable. Free cash flow margin of 23.79. This is like, how can the market take this kind of fundamental data and be in this mode of selling off this company? I don't know. I don't need to explain the mentality of the market, the motion of the market. I just kind of seize the moment and buy. So these IPOs, I have to practice a little bit of patience, diligence, because it could present a really nice opportunity. But when you buy, how you buy, the price you pay is extremely important. That's what makes the difference between somebody making a lot of money on Reddit and somebody not making any money on Reddit and for a long time was losing money on Reddit. So that's enough said there, sir. Let me pass it over to you. I think you wanted to cover Fortinet.
Yeah. And I couldn't remember whether you said they were priced at a premium or a discount.
Discount.
Okay. So whenever you see something like this, it's always a little scary. And the saying goes, when in doubt, zoom out. So
That's an expression, huh?
yeah, let's zoom out and let's look at where this base formed after that drop. And look how it's supported here. This is the same price that it traded there. So that's a support level. And it also found a support level there almost at that same exact price. The next down level of support is about right here. So I'm going to measure in percentage terms from one support level to the next. It looks like about a 13% risk. If I bought at these prices today, there's about a 13% risk to the downside. If I take this and just measure it back up to where it had traded for months, I have a 32% upside. So your reward to risk is in your favor to buy Fortinet at this time. So zoom out, take a look at where the support levels are, look at your risk and reward, and make a decision based on that. So this looks like a good time to step in. I was doing the same thing with the stock that I had that's taken a hit today.
Mm-hmm.
So where is it trading at today? I see 3 support, or at least 2 support levels there. And the next support level is down about 32. So I've got about 10% downside. This company is also priced at a discount, but even trading back up to its most recent 2 highs, which were in March and July, it's a 17% upside. So this actually might be a good time for me to. I sold 16% of my portfolio about 4 days ago. I may pick up that 20% today based on this analysis.
Very interesting. Thank you. So, not sure how you're doing on time, sir. I've got two more stocks that I wanted to cover, but I wanted to respect your time.
Yeah, let's look at them.
All right. We're on a roll. We're on a roll. It's Friday. We don't get to do this tomorrow or Sunday. Why can't we trade 7 days a week? I guess the computers need a day off over on Wall Street. All right. So we're going to talk about ASML. ASML has been going up and up, and I was able to get myself into ASML. I kind of, I'm a dollar cost average investor. And on this occasion, it's probably held me back a bit. I've got a little position, but it's been going up. So I guess there's no crying in baseball, and investors that make money shouldn't cry either. And this stock here, when you consider the fact that it hasn't really been a superb winner over the last 5 years, while the semiconductor industry has just been going crazy, is a little bit of an oxymoron. It's a paradox that these guys haven't advanced along with NVIDIA and TSM, Broadcom. So it presented, I continued to look at ASML and finally found that, it's the right time, and the valuation was good, and I started buying. The PE ratio is 33. It's a big business. This is on US dollars, $362 billion in market cap, $37.6 billion in revenue. Big business, paying 10 times revenue. They have one of the strongest moats that you can find out there, because they create these machines that these semiconductor foundries will use those big machines, and each machine's like tens of millions of dollars. It's like, hey, I'd like to buy one of those. Okay, it'll be $25 million. Would you like to buy the extended warranty on that? That'll be $2 million a year. And it's not like the stuff that I buy at Home Depot. And they're growing. So they're growing, trailing 12 months growth of 26%. So they're buying these big machines. The semiconductor companies, no big surprise, are buying these machines because they got to make more semiconductors. So that looks really good. They make a machine, so their margins are not like that pharmaceutical company we saw at 84%. It's not like the software company we saw. It's not like Reddit at 91. They physically have to put materials into the product. They hire really qualified, expensive employees to make these machines that are just going to be flawless. So their margins are a little lower, but their profits are fantastic. So this was an opportunity, and I jumped into it. I just don't think I didn't jump in head first. And again, no crying in baseball, and I am up on the stock. So let's take a look at the valuation. So I still think they're discounted by 11% as I speak. And this is a stock with the moat that they have. I will buy it at fair price. If this stock, I'll continue to dollar cost average until this stock's trading at 0% discount, because they're just going to get more and more valuable over time. We're not going to stop buying semiconductors. I mean, could you imagine the world in 20 years if today a car has, I don't know how many semiconductors in it, probably like 50, if not 100. And every home appliance that we buy, like we have a refrigerator that has like semiconductors everywhere. So the demand for semiconductors just continues to go up, because the semiconductor technology continues to get smaller, which is why these machines are so needed. The whole semiconductor manufacturing process doesn't have any human hands involved. It is all program machines that are doing all this because they have to do it at the microscopic level. And these machines are a necessity. So ASML, I'm going to accumulate it, and hopefully I can build a nice, good position and not take any unnecessary risks. If we have a nice sell-off and the market were to discount ASML, I would increase my capital into the stock. I'd accelerate it so I can have a nice position in ASML. I could see myself holding this for years, but we'll see how it goes. So that's ASML. Do you have any charts on ASML?
Yeah, if I were in a buying mode, this is where I would switch from a 20-day simple moving average to a 21-day exponential moving average. And I usually change the line color to green. Whenever I see it accelerating like this, it's definitely in a pretty solid uptrend. And when it is in an uptrend like that, anytime it touches the 21-day EMA, I'm looking at 3 times here in this run from May to July. It touched it 3 times. Those are great buying opportunities. If it breaks down below that or the 50-day line, then I'd probably stop buying. But as long as it's in this configuration like this, I'd be a little cautious because the RSI is pretty high. And let's go back a couple of years or 2 or 3 years. When it does go into overbought, it only stays there for a week to maybe a month over the last 3 years. So we're so far looks to be about a week into this. So I wouldn't expect to stay overbought. It's either going to flatten back out or have a little bit of a correction or a reversal here. If it comes down and touches that 21-day line, and I was interested in buying this, I don't own this, but that's the way I would approach it.
Yeah.
And then just if you have any concerns when if it drops, use your standard risk management techniques to get out.
Perfect,
PPO
sir.
is really high. I go back a couple years. It looks like the high, well, not the highest PPO we've had. We had higher back here. So using a couple years, I mean, you can go back 3 years, and wow. So if we go back there, I mean, in its past 3 years, it has run up to about 7.31% there. So you have a little bit of potential for upside here still. And accumulation has restarted after reaching a 3-year low back in April. It has definitely been increasing and is not far from a 3-year high. Looks pretty good to me, Victor.
Yeah. And it's one of those where, I'm a dollar cost average investor. That's not going to change. It's just, for me, it's incredibly difficult to pick the perfect time, like the bottom, but I know the range when stocks are really good. So ASML is in that range. I'm buying it. We'll see how it goes. So the last stock that we're going to cover is Monday. It's up 3.5% over the 5-day. It's up nicely. It was up a lot yesterday, 9.5%. This is a stock that came up. Another member of the community brought it up on August 10th, and we're at September 18th, 19th. So in that time, I analyzed it, found that it was really nice discounted stock. I thought that their business was doing quite well. bought into the stock. It's a 30% grower, and this is a software company, a little bit like QuickBooks out of Intuit. They have gross margins of 89%. So they're small right now. And as they get bigger, they're going to really expand their profitability. And they have good free cash flow at this time. The forecast, we've got 24 analysts covering this stock. It is not a stock that is going unnoticed. It's got a nice, good price targets there showing that the stock could be 42% discounted. And the growth is going to persist. Really nice growth in the future. So that looked really good. Profitability is going to expand nicely. So as I look at this stock and look at what the market's been doing with this stock, hasn't been doing much with it. It IPO'd, back to that IPO story. Remember, guys? Stocks run up after their IPO and then they crash down. Market wants to get to know them better, and then over time it does better. The 1 year, the market has not treated small cap software companies all that kindly. And Monday's an example. But more recently, this stock's flourishing. And I think I did pick a good time to buy this stock. And this one here has really risen nicely for me over the 1 month. So this has been a nice, 19% gainer for me in about a month and a half. I think it has more room to go higher. So thanks to the member who brought this one up. We analyzed it, and man, we hit pay dirt really fast on Monday. Still discounted by 24%. And this stock could continue to expand its equity value because as it gets bigger, the fundamentals are going to change, and I think potentially get even more positive, more valuable. And this becomes more and more valuable over time. So Monday, really nice win for the small caps, for the software companies. And let's hope that software continues to rally, because I think it's been left behind and there's no reason for it. They have terrific margins. They're really good industry that has created so much wealth. What are the charts showing on Monday?
Yeah, on this last pullback, it has broken several levels of support. So it broke one at about 231 and got down to this one at 178. So I'm looking back from this price that it's currently trading at clear over to here, and it found lots of support at that previous resistance point.
Mm-hmm.
So in my opinion, I don't see much of a drop after that. The next support is just right below that. So your downside risk from this price is probably less than 10%. But I mean, if you get back up to here, you're looking at a 77% increase. So let me pull out to a year. Let me stay there for a second. You can see this 21-day EMA. Once it crosses above that, it runs along that 21-day EMA for quite the period. Here it dropped below it for just 2 or 3 weeks. It gets above it and it pretty much rides that line for months at a time. So let's drop it back down to a year and let's see where we are. We just popped above the 21-day EMA, which is upward sloping. This looks like a really good opportunity. You have so little downside. You have 77% upside, and you're above an upward sloping 21-day EMA. You do have a little bit of resistance that you could face here at 222. There is a gap that needs to be filled, so you'll have some resistance there at 248. And then your next level of resistance will be about 261. And if it breaks above that, then it could actually surpass this previous highs. So it has
Excellent.
a few things it has to jump over here, but it looks like it's set up very good from a technical perspective. It's not overbought. Your PPO is in negative territory, but you had a bullish crossover on the 26th of August. On the quadrant chart, the relative rotation chart, it is showing relative strength higher than the S&P 500 and momentum stronger than the S&P 500. It reached a one-year low on accumulation distribution in August, and it's climbing back up with the highs still far above that. The money flow has gone from negative over the last 2 months into positive territory and is not slowing down. So this is a really solid time, in my opinion, to move into this one if you're not
Awesome.
already.
Well, thank you. I'm glad that I'm in it, and excellent analysis. Thank you. So that's it for the show on this occasion, everybody. Thanks so much for tuning in. We had a lot of attendance today, so thank you. We had over 100 attendees. That's awesome. If you like this kind of research and analysis, consider being a member. You get greater access to my analysis and the tools that I use, and you actually get access to calls where we have similar conversation. Of course, it's a call, so we get to talk to one another. That's available at the advanced investor level. I can take individual stock requests and do full deep dive analysis with super investor or platinum investor levels. I have a really nice population of sponsors at this point, members, and we're really getting a lot done. A lot of good ideas, a lot of good small cap ideas are coming up, and I really appreciate everybody's support. It's a YouTube channel, it's been fun to have, and my primary goal is to make as much money as possible from my investments. But along the way, what's made me better is really collaborating with other investors. And I really appreciate all members that have been active in bringing up ideas on stocks that we can analyze and see if they're good opportunities or maybe if they're potentially risky situations. So consider being a member. It'd be great to have you. And thanks again to the Super Chat sponsor, Malt Licky, Texas. And thanks for all the members that attended. And thanks for everybody else that was in attendance. Really appreciate you being here. And thank you, Daryl. Excellent work today again, sir.
Thank you, Victor. It was a pleasure to be here.
All right, guys.
Thank you, everyone. It was great to see your comments.
All right. Enjoy your Friday and your weekend. And we'll be back on Monday at 9 a.m. Eastern again, if you'd like to see our analysis. And for now, everybody, good luck with your investments and have a terrific weekend.
Take care.